Hello, I'm Dowie and welcome to this video. Today I want to talk to you about the Jackson Hole meeting that happened last week. So what is Jackson Hole and why should you care about it? Well, Jackson Hole is a place in Wyoming, America, where every year the central bankers of the most powerful economies in the world, policymakers and top economists get together. They give speeches about the direction of the global economy and trying to give their thoughts on where the markets will move over the next 6 months. This may feel like it's not very impactful to you and far away, but this will have a direct impact on your mortgage, your savings rate, the job market, and the prices that you pay at the till. So let's break this down together. So, the big headline here is that the US Federal Reserve, which is the largest and most influential central bank in the whole world, has changed its policy stance from being more hawkish to more dovish. Now, in economics, we have jargon words for things like this. A hawk basically represents a central banker that is more aggressive in its fight against inflation. So what that means is that they increase interest rates, which increases the cost of borrowing. And essentially what that means is it decreases economic growth. Whereas a dove is something that's more peaceful, right? That's something that's going to reduce the interest rates, reduce the cost of borrowing for me and you, and increase economic growth. So why have they made this change when people like me and you have been feeling the pinch for a couple of years? Well, over the last 25 to 30 years or so, we haven't really seen much inflation. But since COVID, we have had a return of inflation. And what that's meant is that central bankers had to increase their interest rates in order to ensure that price levels didn't spiral out of control. Now, they are now starting to think about changing their attention away from inflation and towards economic growth. This is because central bankers, particularly the US, but here in the UK too, have a dual mandate. They essentially are tasked with the objective of ensuring that inflation is under control at a steady level, around 2% is the usual target. And also we have something called maximum employment, which basically means that we have a healthy job market, there aren't loads of businesses going out of control. They do this through the lever of being able to increase or decrease interest rates, which basically either increase the amount of money or decrease the amount of money in circulation. So now this pivot is basically signaling that the US is more worried about job losses and effects to the economic growth of the economy than it is the inflation risk. The inflation is going to return and continue to spiral out of control. So there's this swap in priorities. So what does this mean for you here in the UK? If the US is observing that the risks to their economic growth has gone up, well, we usually follow suit, if I'm honest with you. The Bank of England here usually follows the US Federal Reserve in pretty tight lockstep. Our economies are pretty intertwined, and that means that we're likely to see interest rate cuts here in the UK too. So, what does that mean? Well, three main things. First of all, mortgages and loans are going to get cheaper. So if you're looking to make a purchase of your first property, or if you're looking to remortgage your home, potentially you're trying to finance a vehicle for work or something along those lines where you need to borrow money from a bank, well, this signals that you should probably wait a period of time for these interest rates to come back down a little bit so you can borrow at that cheaper rate. The second thing is savings accounts. So the other side of the mortgages and loans, the people that are saving and lending their money rather than borrowing it are going to receive less income. So savings account rates will come down as a result of this. And that basically means if you have an account that's giving you 4.5%, maybe 5% at the moment, then maybe that comes down to 3% or 3.5% over the next 12 months. What this generally means is that your purchasing power of your money comes down. Inflation eats more of it, and generally that means that more people are likely to invest that money, take that risk, and try and get that higher return because their risk-free rate has been reduced. That means more money into the economy, more stimulation, more jobs, more economic growth. The third thing is a stabilizing job market. Now, the data doesn't currently suggest that there's these huge spikes in unemployment occurring, but it does suggest that it's starting. And these central bankers are currently switching their objective towards a more healthy economy, concerned essentially about the underlying spikes in employment that may be coming. So although it may get worse before it gets better, this essentially means that with cheaper borrowing costs, there may be more hiring in 6 months' time than there currently is. I know from personal experience, my younger siblings and their peers are really struggling in the graduate job market at the moment. So this will help them out. So the news from Jackson Hole is significant. It signals a change in economic policy with opportunities and challenges for your personal finances coming up. Understanding these shifts is the first step in making smarter decisions. So if you fancy learning a little bit more about how these big economic forces can affect you, then get in touch with me and I'll be more than happy to help you out.